Russia, Fed, so many things weighing on this market, but market surprisingly doing some bullish things. We'll talk about that today on 3 Minutes on Markets and Money. Yesterday, the markets rallied off its lows after the release of the FOMC minutes, which suggested that even though the Fed may be hiking rates and tapering their balance sheet, that taper may not occur until later this year. So that gave some relief to the markets that the Fed may be overly aggressive early on. And so markets did rally into yesterday's close. Now, importantly, a couple of things happened yesterday. Markets did rally back, closed above the 20-day moving average. So that's actually kind of a bullish sign. Sets the market up here to rally to the 50-day moving average. Now, this morning, markets are going to open weaker because of, again, concerns over Russia, right? Russia said they're removing troops. The United States says, no, they're actually adding more troops. Who knows what's going on? But certainly geopolitical risks, certainly weighing on markets short term. However, as I said, the markets have actually been developing a little bit more of a bullish trend to the markets as of late after retesting those lows in January. We saw those lows here back in January. The market's actually now kind of setting up a series of rising bottoms. So we have this bottom here that we came and retested the other day. Markets have rallied here a bit, setting up a higher bottom relative to that January low. Now, we're also building a bit of a wedge. We do have a fairly clearly defined downtrend in the markets currently, but this is now starting to compress prices into this kind of wedge pattern of the markets. So if we do get a breakout outside of this wedge to the upside, that's going to suggest a fairly strong counter trend rally, could even retest previous highs. A break below that, of course, will also set up a decline. So again, you're not out of the woods here just yet by any stretch of the imagination. So keeping some hedges in place, being a little bit more cautious with your allocations certainly makes some sense. But these rising bottoms do typically suggest that the market is trying to establish a bit of technical footing here for higher prices, at least in the short term. Now, these things don't last forever. This doesn't mean we're about to move into the next great bull market of 2022. It just suggests that here over the next couple of weeks, as we get ready to head into the Fed meeting, that the markets are starting to incorporate what they expect the Fed to do. So if the Fed kind of comes in with, say, 25 basis point hike, an announcement that they're looking at tapering the balance sheet later this year. In other words, any type of statement that is a little bit more on the dovish side, that is already getting kind of priced into the markets here. We could see the markets rally on that news. Of course, if they come in a lot more hawkish in March, that would certainly set the markets up to go lower. So again, this pattern doesn't mean that we're about to have a bull market. I don't want you to take that away from this at all. But what it does suggest is that we've now got some clearly defined breakout patterns for the markets. If we do break out to the upside, particularly above the 50-day moving average, that's really going to set the markets up for more of a rally here. So really kind of watch that level. A break and a close above that 50-day moving average will be an opportunity to add some money into equity positions, reduce your hedges. If we do break out to the low side here, that's going to set up for an immediate retest of the lows that we had back in January. A break of those lows of January is going to set the markets up for a deeper decline, probably to around 4,000 on the S&P. So again, at that point, reduce equity risk, add more hedges, etc. So again, not out of the woods by any stretch of the imagination, but we are seeing a little bit of a bullish improvement to the markets despite all the angst in the markets over Russia, the Fed, interest rates, inflation. Markets have actually been holding up here very well. And so that is showing some sign of that we do have inflows coming into the markets. Money is being put into equities, although we're not seeing a lot of result of that just yet. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll see you next time.